Okay, we have 8 o'clock straight up. I want to welcome everybody to the 8 a.m. Market Insight with Mike on May 29th, 2020. It's 8 o'clock. We're going to get started. Last week, we did our initial attempt at having Mike update us on what's happening with the markets, and we thought we would try a little bit different format this week. First, I'd like to introduce Mike McCauley. He's in charge of our investment platform here at First Option Bank. And we also have now opened up the group chat for questions. So if you have questions, go ahead and send them to me, and I will filter them to Mike and he will answer them. We had a few questions that came up last week that I think we'll start with. Although Mike did indicate that he wanted to start with the same chart that we had last week. Let me see if I can find it right here. Okay, you should see on the screen, Mike, do you have that?
Got it.
Okay, you want to go ahead?
Okay, this is our Dow Jones COVID-19 relative chart. It shows the what the Dow Jones Industrial Average has performed since all this started. And you'll see on the far left, this was about middle of February, and then we had our biggest dip right around March 23rd. And we talked last week about a recovery and what type of recovery we would see. There are several different types of recoveries. You have a V, you have a W, you have an L, and then you have what we're referring to as the Nike swoosh. And you can see here, we have what we're kind of seeing as the Nike swoosh. We had our bottom around March 23rd, and then you can see the blue line goes up. And the most interesting part about this is, number one, is recovery has been relatively quick. But the other thing that we wanted to make sure we pointed out this week, since this is somewhat market intelligence, since May the 1st, today is the last trading day of May, since May the 1st, the market's actually up 7.1%. That's a 1 month performance, which is, that's exciting. It's not great, we're still down, but it's very exciting to see a chart like this where you can take a look at it. You can see the red and the green line are moving averages. Those are all going up. So this is all, for us, relatively positive signs, although we remain cautious that we may see another decline in probably July or August. So we wanted to start with that, show you where we are, where we've been. This tends to not get a lot of press. The second thing we wanted to talk about was a question that came in last week, which is great questions on unemployment. So this is our unemployment chart. You can see that on average, we run about 230,000 applications for initial employment a week. That spiked, and we've got approximately 14% unemployment now. Someone had asked me if we would see unemployment reach the Great Depression levels. I suppose that's possible, but what's important to note here is that the blue line is how we're trending the monthly reports, and you can see that's kind of dropped. We had a spike. We've got right now about 30 million unemployed. That's not good news. However, you can see that it's leveling off, and we'll have to see where that goes. We know that in travel and leisure, that number isn't probably going to change too much over the next 6 to 12 months. But as the restaurant gets back, those come back. As companies bring people back, that comes back. So we did have the spike. We don't think we're going to see it hit that level of unemployment that we saw during the Great Depression, although it's still a big number. A great question that we got at the end of last week was housing starts. I spent about 14 years in the housing business, so this is kind of near and dear to my heart. This chart shows housing charts going back, and you can see we reduced that and put it down in some kind of form that you can see. And the red line indicates 1.2 million starts per year. That's where the NAHB, National Association of Home Builders, likes to see as an annualized number for housing starts, 1.2 million. So you can see, I mean, it bounces around a little bit. And then we have 2008, which is over here on the far right-hand side. And we recall that about 11 years ago where we had the financial crisis and housing starts took a huge drop. And then you can see that since 2010, over on the far right-hand side, we've had an increase. And then in 2017 and 18, we crossed above that 1.2 million start line again. So we were doing pretty strong. And then Chris, go to the next slide, please. Well, what we're going to see, what happens is over here on the far right-hand side, we're down to about 891,000. Now, we haven't added that in because it was a 1-month report. So we'll be adding that number in the next couple of weeks. But this blue line over here is going to drop back below that 1.2 million starts. So why is this so important? Housing starts is a huge factor in the economy because housing starts represents skilled trades. It represents plumbers, electricians, carpenters, and then it directly reflects consumer durables, refrigerators, stoves, all types of appliances. It involves flat work, concrete work. It just involves an incredible number of skilled people and jobs. And that's why housing starts are so relevant to the economy. And that's why we really want to see them at that red line or better, the 1.2 million starts. We really want to see that bump up. So the next couple of weeks are going to be really important. We typically see a bump in housing starts in April and October. Obviously, April's going to be iffy if we see that bump. And we'll have to go from there. We'll have that in about 2 weeks. Another question we had was on Roth conversions. Someone asked if it was a good time to do a Roth conversion. So let's talk about that for just a second. An IRA is an investment tool where you have, and it's taxable when you withdraw the money. So you pull it out, it's all taxable. On a Roth, at this point, Roths are non-taxable. So it's not tax deferred, they're just a non-taxable tool. When the market goes down sometimes, it's a good opportunity to convert your IRA to a Roth IRA. The issue is, number one, it's a taxable event. And sometimes it's a good opportunity in a declining market to take advantage of that. It's all relative to who the client is, how much you have, and to some extent, how old you are. So you need to talk that with your individual advisor and see if it's a good tool for you. But in a declining market, if you've got a sizable IRA and you're less than 50 years old or so, it's a good opportunity to take a look at it and see if that might work for you. And then the final question we had afterwards, is this a good time to invest in the market? I'm going to refer back to our initial chart. A good time to invest in the market is probably yesterday. You got to be in the market to participate. We know that if you miss the top 10 days of any 12-month period, you're probably going to have a flat or very small or small decline. So jumping in and out of the market probably isn't the best decision. So the time to invest in the market is to be invested and to just have good things and to be allocated properly across cash, equities, and fixed income. And then you don't have to worry about trying to do market timing. When should I go in? When should I get out? You should be in with the right stuff, and you should be in consultation with your advisor and make sure that you're doing what works for you.
We did have one more question last week. Are there any particular sectors that you would be looking at now as opposed to others? What should you be avoiding at this point? You mentioned last week hospitality and travel. Is there anything else that you would stay away from at this point? And is there anything that you are looking at as maybe a really good opportunity to enter into the market at this point?
That's a great question. We actually have a couple portfolios that we've designed that take advantage of sectors. So we know that there are 13 sectors. There are some we're cautious of. We mentioned last week, travel and leisure we're a little cautious of. In healthcare, we know that somewhere in healthcare, there's someone that's going to have the answer to this, and they're going to come up with a vaccine. They're going to come up with something. We don't know who that company is. So we buy ETFs that take into consideration the healthcare sector. We know that there will always be a demand for utilities. There will always be a demand for financial services, and there'll always be a demand for healthcare. So we know those areas are relatively strong. Consumer durables are a little questionable right now because those are the things that consumers are buying if they have disposable income. Sometimes they'll replace the washing machine before it needs to be replaced. Now they don't replace the washing machine until it has to be replaced. Consumer staples are things that you have to do every day: cleaning, bathing, washing, taking care of yourself. That's a relatively stable sector. And then you have utilities, which are a little bit different than some of the others. Utilities are out there. They pay relatively good dividends, although utilities tend to be kind of highly leveraged. and they are regulated heavily. So of the 13 sectors, our best advice is to keep yourself spread around all of them based on where we are in the market. And that's why we have one of our portfolios designed like that. We have right now about 3% real estate. We've got about 22% in information technology. We've got about 14% in financials. So there isn't really one sector that we would focus in, but we would go across a couple of sectors, and the safest ones are the healthcare, the financials, and the utilities. Those are the ones where we go.
Moving away from the safe piece, you and I have had a lot of discussion lately about the energy markets and specifically oil.
Right.
What do you think of the action in the oil market, and what do you see as the headwind for anybody that may be looking at an ExxonMobil as an entry point right now?
That's a great question. Some of those companies, I'm going to use Phillips 66 as an example. The oil companies function, all of them do it a little bit differently. Phillips 66 tends to be one of those companies that diversifies themselves. They deal as much in transportation and movement of the product as they do in refining and selling the product. Some of the other companies are more focused in drilling, developing, things like that. What you need is, again, we're going to go back to diversification. You have oil selling at record low amounts. Will it stay like that? Of course it won't. It'll start going up. So you want to have some parts of your investments into oil, into gas, into perhaps drilling, maybe, depends on your risk level. There's been a lot of talk on this ETF called USO. That's an interesting product that a lot of people got into without knowing what it actually was, which is essentially oil futures. So where's oil going to go? It's kind of hard to believe that it won't go up. But again, our guidelines typically are you don't want 5% of your portfolio in any one single stock, because overnight, as we've seen in the last couple of weeks, a stock could decline 45, 50%. And that has a big impact. So there's a lot of opportunity in the oil and gas area. There's a lot of opportunity in natural gas. There's a lot of opportunity in energy in general. You still have to weigh your risk level on how much you really want to be into.
Last week you mentioned the possibility of the market coming apart a little bit in July. And I think it's probably good to maybe elaborate a little bit on what we're seeing with potential COVID issues versus the election and how those two are going to weigh against each other as you look out for the next 2, 3, 6 months.
I think the next 6 to 8 weeks are going to be really interesting. I'm going to use that. I was reading really early this morning a list of the states where the virus is spreading the fastest, and it was listed in the slowest to the fastest. The slowest was Hawaii. Hawaii has the slowest right now per capita rates of infection, but Hawaii, a lot like New Zealand, they're isolated. They've been able to really go with social distancing. They've been able to prevent people from coming in. They've been able to really enforce their isolation rules. Some of the states that aren't are states like Florida, New York, California. Connecticut is starting to see an increase. They're right now #1 in the last 7 days on virus growth. A lot of it depends on how we manage it. I had someone in the last week send me a really interesting chart on where the high states were, where the low states were. And I looked at those numbers really close. And what I found was that the highest rate of death happened to be in those states with the highest rate of population per square mile. So this isolation that we're dealing with, the mask and prevention, it depends on how well we manage coming out of that as far as what happens. But generally, just because we're getting back to being social, we're getting back to getting close together, we will see most likely another rise in the virus. Most likely we'll see it in July. But there's certainly, if we don't come up with a vaccine between now and Thanksgiving, we will most likely see another hit in early fall or early winter.
And what impact do you think the election is going to have on the markets?
That's a great question. In past years, we've been able to be a little bit more forward-looking on the election. This year, I think it's still tenuous because there are going to be questions that can we do this election like we've always done before? Are we going to be able to manage having people stand in line to cast their vote? How are we going to be able to do a mail-in ballots? How's that going to happen? The other part is how much of the economy and the impact on the economy, the high unemployment, is going to be blamed on the current administration rather than the anomaly of a virus. So it's really an unknown right now. And the part that bothers me about that, the reason why that's such a good question, is generally the stock market doesn't like the unknown. So the closer it gets and the less clear the results are, the more volatile the market's likely to become. But the stock market in general, it's a living, breathing thing, and it just doesn't like things it doesn't know. And that's where we could see some volatility going forward.
Okay. Well, we're pushing up against our 20-minute limit, and I don't have any additional questions. And for those people that are tuned in, if you have a question that you would like to have answered, in the invitation that went out is my email address. Shoot me an email, and we'll either talk about it next week, or I'll have Mike answer that question, during the week, and we'll shoot you an email and get it back to you. In the event that something comes up that you'd like to discuss, please feel free to give us a call and we'll get on that immediately. So, Mike, I sincerely appreciate you taking the time. I hope that this has been informative for people, and I hope it gives them an idea of some of the things that you and I think about on a daily basis. So, anything you have in parting?
I think it's great that everybody joined. This is a wonderful opportunity to reach out and touch our clients, our friends, our families. And we hope all of you come back every week.
Very good. I appreciate it. You have a good day, Mike.
Yeah, thanks, Chris. You too.